As the Federal Reserve holds the highest rates in decades, every American feels the ripple effects. Before we break down the causes and consequences, here's why this moment truly matters. The monetary policy of the United States Federal Reserve is one of the most powerful forces shaping not only the American economy, but also the global financial landscape. Understanding the Fed's decisions is no longer optional knowledge reserved only for economists or financial professionals. In today's interconnected world, every individual living, working, or investing in the United States is directly influenced by the Fed's actions. Interest rates determine the cost of borrowing, impact mortgage payments, move the stock market, and alter the global value of the US dollar. Therefore, analyzing the causes, consequences, and opportunities behind the Fed's policy is essential in navigating economic uncertainties. Over the past few years, the Federal Reserve has maintained interest rates at a range between 5.25 and 5.50%. These are the highest policy rates seen in more than 20 years. Such a drastic measure did not appear out of nowhere. It was the result of a chain reaction that started in the aftermath of the COVID-19 pandemic. As the U.S. economy reopened, millions of Americans rushed to travel, shop, dine, and resume activities they had postponed. At the same time, global supply chains were struggling to recover from factory shutdowns, shipping delays, and labor shortages. This mismatch between strong demand and limited supply pushed prices up everywhere. Adding to this dynamic was massive government stimulus. To prevent economic collapse during the pandemic, the U.S. government injected trillions of dollars into the economy. Households received direct checks, businesses obtained subsidies, and unemployment benefits expanded significantly. While these measures were necessary at the time, they also increased the amount of money circulating in the system. With more cash to spend and fewer goods available, inflation surged to a level not seen since the early 1980s. The Federal Reserve responded with a powerful series of interest rate hikes. By increasing interest rates, the Fed aimed to slow down consumption and borrowing. Higher rates make mortgages, car loans, credit cards, and business loans more expensive. When borrowing becomes costly, households tend to reduce spending, and companies scale back hiring or investment. In theory, when demand cools, prices also start to decline. This method is not pleasant, but it is among the most effective tools the Fed has to control inflation and bring it back toward its 2% target. Yet the path to lower inflation has not been smooth. Certain segments of the economy, particularly housing and services, remain stubbornly expensive. One main factor slowing inflation's decline is the labor market. The United States has consistently maintained a low unemployment rate, hovering near historic lows. Wage growth has remained healthy, and American workers continue to have jobs and stable incomes. When consumers are employed and earning more, they continue to spend, keeping demand high. This strong labor market, while positive in many ways, complicates the Fed's battle against inflation. The housing market adds another layer of complexity. Millions of American homeowners refinanced their mortgages during the pandemic when interest rates were at record lows, sometimes as low as 2 or 3%. Because these homeowners are locked into such favorable rates, they are reluctant to sell their properties and take on a new mortgage at today's much higher rates. This lock-in effect has led to a significant shortage of available homes for sale. When supply is limited, prices remain elevated. Even rents have climbed because demand for housing has not dropped. As long as housing remains expensive, a critical component of inflation stays high, forcing the Fed to remain cautious about cutting rates, despite the Fed's aggressive tightening. Inflation's persistent pockets raise difficult questions about the appropriate pace of future monetary policy changes. Lowering interest rates too soon could reignite inflation, but keeping rates too high for too long risks pushing the economy into recession. It is a delicate balancing act, and every decision the Fed makes carries profound consequences. The first major consequence for Americans is a noticeable increase in daily financial pressure. Credit card interest rates have climbed to multi-decade highs, often surpassing 20%. For families relying on credit to cover everyday expenses, This creates a dangerous cycle where debt becomes harder to pay off. The cost of carrying balances grows and financial stress increases. The second consequence affects home buyers. Elevated mortgage rates, combined with already high home prices, have created one of the least affordable housing markets in modern U.S. history. Many young families find themselves priced out of home ownership. The wealth gap widens as those who already own property accumulate more equity, while those who do not struggle to enter the market. A third consequence touches the business community. High interest rates increase borrowing costs for small and medium-sized enterprises. These companies often rely on loans to expand operations, invest in technology, or build new facilities. With rising capital costs, many businesses postpone expansion plans or reduce hiring. Some with weaker financial foundations may even shut down altogether. While large corporations often withstand these conditions better, small businesses, which make up the backbone of the American economy, feel the pressure more sharply. A fourth consequence plays out in the financial markets. Although the U.S. stock market has shown resilience, investor sentiment remains fragile. Every statement from the Fed chair or a member of the Federal Open Market Committee can send stock indices soaring or plunging within minutes. This volatility makes it challenging for both professional and individual investors to maintain steady strategies. Markets thrive on clarity, and prolonged uncertainty complicates long-term planning. However, economic challenges always come with potential opportunities for those who understand the dynamics at play. One area benefiting from higher interest rates is the bond market. When rates are high, new bonds offer attractive yields, drawing long-term investors seeking stable returns. If the Fed begins to cut rates in the future, existing high-yield bonds will likely rise in price, giving investors a chance for capital gains in addition to interest income. For many, the current environment may be a rare window to enter the bond market at favorable levels. Another major opportunity arises in the stock market, but timing is critical. Historically, periods when the Fed shifts from raising rates to cutting them often mark the beginning of strong bull markets. Growth stocks, technology companies, and interest-sensitive sectors like real estate tend to perform exceptionally well during these transitions. Investors who position themselves early may benefit significantly once monetary policy becomes more accommodative. The strength of the U.S. dollar presents both challenges and opportunities. During rate hiking cycles, the dollar typically strengthens, making imports cheaper for Americans but hurting U.S. exporters. A strong dollar also gives Americans greater purchasing power when traveling abroad. However, once the Fed starts easing policy, the dollar may weaken, improving conditions for American exporters and multinational corporations. Those involved in global trade must monitor these shifts closely to take advantage of currency movements. A final opportunity appears in the housing sector. While current conditions are difficult for buyers, moments of high rates often create reduced competition. Potential home buyers who prepare financially, improve their credit scores, save for down payments, and understand local markets may be well positioned to act when mortgage rates eventually fall. When the Fed signals a rate-cutting cycle, demand will likely return rapidly. Those who are ready beforehand will benefit the most. The Fed's influence does not stop at the borders of the United States. Because the U.S. dollar serves as the world's primary reserve currency, Fed decisions impact global capital flows. When American interest rates rise, capital tends to flow into the United States in search of higher returns. This can weaken currencies in emerging markets, increase their cost of borrowing, and pressure their economies. Countries with high levels of U.S. dollar-denominated debt face greater repayment burdens. Conversely, when the Fed cuts rates, global capital may move back toward riskier markets. This can boost economies in Asia, Latin America, and Africa, helping stabilize currencies and reduce financial stress. For the world economy, Fed's policy decisions can dictate cycles of expansion and contraction far beyond U.S. borders. This introduces the Fed's greatest challenge: how to reduce interest rates without triggering a second wave of inflation. If the Fed cuts rates too rapidly, consumers might accelerate spending again, pushing prices upward. On the other hand, if high rates persist for too long, business failures may rise. Unemployment may increase, An economic recession may become inevitable. The Fed must navigate between these extremes with precision, relying heavily on incoming data related to employment, consumer spending, wage growth, and inflation trends. For everyday Americans, understanding the Fed is not about learning technical jargon. It is about recognizing how interest rate changes influence daily life. Mortgage payments, credit card debt, job opportunities, retirement savings, and investment decisions. When the Fed raises or lowers rates, it affects the value of the dollar, the strength of the financial markets, and the cost of living. For everyday Americans, understanding the Fed is not about learning technical jargon. It is about recognizing how interest rate changes influence daily life. Mortgage payments, credit card debt, job opportunities, retirement savings, and investment decisions. When the Fed raises or lowers rates, it affects the value of the dollar, the strength of the financial markets, and the cost of living. Those who follow the Fed's actions closely can prepare more effectively. By understanding the signals, individuals can choose the right time to refinance a mortgage, invest in stocks or bonds, or adjust their saving strategies. Awareness also helps consumers anticipate changes in their monthly expenses and long-term financial plans. The Federal Reserve's decisions shape the economic environment in which every American operates. As the Fed continues to assess inflation, labor market conditions, and global uncertainties, the direction of future policy will remain a central force influencing the path of the U.S. economy. For that reason, staying informed, thoughtful, prepared is one of the most important steps individuals can take in managing their financial future.